I'm Steve Walker, lead analyst for banking and payments at Global Data. I'm going to talk briefly on banking in the post-pandemic environment. It's a familiar refrain now, a decade of channel shift in 12 months. The volume and velocity of change has been extraordinary. But it's not just what happened in the last 12 months, but how the last 12 months changes what's coming in the next 60. One measure of that is the increase in e-commerce. Here we see data for UK and China, with the dotted line showing our old forecast and the straight line our revised numbers, with growth on an entirely new trajectory. That new forecast, directionally at least, holds true no matter where you are in the world, as does the drop-off in cash. Some of these behaviors will clearly revert as lockdown ease, but what's different here is how many customers had their gateway digital experience amid the pandemic. Same in banking. Bank of America reports 63% of customers using mobile banking to 72% in just 12 months, with 10% of that increase from net new digital users, people who had never done digital before. In APAC, these trends impacted different banks differently. These charts show percentage of customers that prefer to use digital channels for specific tasks. Those banks in red boxes with consistently low customer preference for digital, so Maybank, CIMB, HSBC, likely had a welcome stick to drive channel migration with the pandemic, but also the real danger that consumer behavior could outpace their channel capabilities. Meanwhile, for institutions with consistently high customer preference for digital, so OCBC and UOB, this was an opportunity to harvest years of digital investment, but also with time to market pressure, particularly on digitizing those more complex sales and service pathways amid the pandemic. Together, net new users and existing users doing more high-risk things online has driven a massive increase in both the frequency and severity of fraud and cyber attacks, a so-called golden age. From February to April 2020, attacks against FS providers went up by a staggering 233%. Even before the crisis, banks had a risk profile unlike other industries, typically seeing 2 to 3 times more attacks given the size of the prize, not only in terms of stolen funds, but the prospect of identity theft. While for banks, of course, the cost of any breach is so much higher, combining reputational, operational, legal, and compliance costs. Particular vulnerabilities amid the pandemic from older customers online, more vulnerable to account takeover fraud and card not present fraud, as we see at the chart on the right. But also the speed at which banks had to implement features. Developers releasing more frequent code updates needed real-time testing and security controls. In particular, the COVID-specific chatbots that were rolled out at pace to relieve call center pressure had to be carefully checked to manage bot credentials so that any unexpected inputs didn't introduce security risks or lead the bots to, in other ways, misfire. No surprise then when we ask executives in Asia what are the key technologies in responding to these threats, cloud and cybersecurity were top. Cloud-based systems help banks adjust to a massive increase in remote working, increase in customer app usage, and heightened security and fraud risk across both. We saw in the pandemic that those banks that were most heavily invested in cloud pre-COVID were much better positioned to stand up these virtual call centers in days instead of weeks, and to modify workflows to disperse much needed government-backed loans. As an example, in Asia, Standard Chartered increased the capacity of its VPN by more than 600% since the beginning of February 2020, as most of its 84,000 employees globally continue to work from home. However, in further implementing these technologies, execs have to balance the short term versus the long term. In cybersecurity, understanding the interplay of tech, people, and process to get their arms around the risks of increased working from home and increased digital, but long term, the need for a more proactive approach to threat detection, in which machine learning algorithms help to anticipate attacks and prioritize responses given the multiplication in incidents and threats. In particular, in a cloud context, the balance between so-called lift and shift, which confines incumbent banks to those cost savings and scalability benefits, to re-engineering applications for microservices architectures optimized for change and reuse. We've seen a mixed strategy here from banks, choosing between big incumbent vendors that can support them day one across all products and all jurisdictions, to those working with a variety of cloud native vendors built on generally cutting edge technology like a Mambu or a 10x. Open banking brings this long term view into even sharper focus. What started as data access in banking and payments, as we can see on this slide, is fast evolving into open finance and open data. Banks need a flexible, open architecture to deliver this, as they must partner across industry lines and around different capabilities. In particular, the trend of so-called embedded finance, in which banks provide some aspect of banking as a service to non-banks, whether an Uber or Spotify or a retailer, as you see in the circle on the top right. So too, banks are partnering to bring in best-of-breed capabilities for internal processes or credit risk or onboarding. Viewed through this lens, banks need more tech flexibility to have multiple routes to market. They're no longer just selling credit to customers, but maybe disaggregating a credit API to go onto a retailer's website, or data on transaction history to help retailers with optimizing shop locations. Doing this well means doing it securely. This slide shows consumer openness to open banking, and it's clear many consumers remain closed. 70% of 75 plus customers don't want third party access to accounts, regardless of what the service benefit may be. And where customers do want open banking, it's often specifically for heightened security. We see here 30 to 35% indicating safe online purchase would induce them to use online banking, open banking. We saw a massive increase amid the lockdown of using open banking to make payments instead of entering card details on a retailer's site. So too for identity verification, where consumers could use open banking to enable KYC compliance and faster, more secure onboarding. And our scorecard analysis emphasizes this point. Here we rank providers of financial services, banks and non-banks, based on their tech capabilities, with a score of 5 indicating a leader in that given technology theme. And we scored these banks in each theme on investment levels, capability, customer satisfaction, cost reduction, and many other factors. And those banks that have the best thematic score represent how well positioned they are to respond to the evolving themes. As we can see clearly here, those that score best in cyber and in cloud score best in overall thematic scores, which represents their innovation potential and the technology capabilities they have in place. Now, when looked at globally, incumbent banks are making these investments in cloud and cybersecurity and managing to close some of the experience gap against new entrants. This chart shows how much customers agree with a statement 2018 to 2020. As we see top left, fewer people agree that branch network and long history matter, which in 2018 versus 2020, which implies an erosion of long-standing incumbent bank barriers to entry. Yet conversely, we're not seeing digital banks capitalize on that to forge competitive distance. On the contrary, globally, many customers actually think digital banks are doing less well in 2020 in terms of offering advanced features and offering more secure access than incumbent banks are, with a rather modest increase in the number of customers that think digital banks are more customer-centric, just up a few single percentage points. Yet when we look at the story in APAC, it's quite different. As we see from looking left to right, there's been a sharp increase in the number of customers that believe digital banks are better across a range of dimensions, as perceived increase in security, improvements in service, perceived to be offering more advanced features. This implies, at least across APAC, that new digital banks have much better prospects than incumbent banks against the global average.